Hi there, I'm Richard Hill, the host of eCom at One, and welcome to episode 185. Now, in this episode, I speak with Michael Appel, Managing Director of Getzler Henrich. Working in retail, restructuring and turnaround for the last 20 years, Michael steps us through his opinion on retail and the real winners in the market and his future retail predictions, reasons why companies fail and the top 3 things to keep a tight eye on, future-proofing your business as much as possible. Turning around a company is a very stressful situation. How do you protect yourself and your mindset when going through this process? And so much more in this one. Great episode. If you enjoy this episode, hit the subscribe or follow button wherever you are listening to this podcast so you're always the first to know when a new episode is released. Now, let's head over to this fantastic episode. Hi, Michael. How are you doing?
I'm great, Richard. How are you?
I am fantastic. I'm a little bit jealous. I think we were having a little chat before we came online, and you're sitting in Florida in an 82, 83 degrees. I'm sitting here in the not-so-sunny UK, but hopefully next few weeks the weather's going to get a lot better. But thanks for coming on the show.
I'm delighted to join you.
So I think it would be great for you to kick off and introduce yourself to our listeners and how you got into the world of retail, M&A, and e-commerce.
Okay, great. Thank you, Richard. Well, I started my career in the 70s, I hate to say this, at Bloomingdale's as a merchant. And I spent about 20 years as a merchant operator, both at Bloomingdale's and at a large big box home furnishings retailer, and then at a series of specialty retailers. And then starting in the 90s, I started to work with challenge companies and in all different categories. And I did a lot of work for Goldman Sachs, where I actually ran 2 companies that they owned in New Zealand, and then also was the interim CEO of Laura Ashley in North America, and was involved with a lot of different retailers, and also worked for bondholders. And then I had my own restructuring firm and performance improvement firm, and have worked for other ones, and most recently, just to do a fast forward, in 2017, I was asked to become chairman, and then I became chief executive officer of a 750-unit specialty retailer called Route 21, which was a sort of teen retailer, guys and gals, and that had just emerged from bankruptcy, and led the turnaround of the very successful turnaround of the company. 2020, I left, and then got involved with another company called Ashley Stewart, which is a plush-size specialty retailer focused on women of color, where I'm chairman of the board. And about 2 years ago exactly, I was asked by former colleagues of mine whom I had worked with in the past to join Getzler Henrich, which is a financial restructuring and performance improvement firm focusing on the middle market. And I lead their retail practice.
Fantastic. That is quite a journey, Michael, isn't it? That's you got
a lot of journey, a lot of different companies.
Like several books, I think. There'd be a whole trilogy of it'd be like Harry Potter versions 1 to films 1 to 8. Probably 20 years worth of, or 30, 40 years worth of.
I probably have about, I probably got 3 books in there, okay? And lots of interesting stories with, with large companies, entrepreneurs, founders, fascinating. And anywhere from the companies that I've been involved with have been anywhere from discounters to high-end luxury like Baccarat Crystal, et cetera. So in every category, apparel as well as home furnishings. So,
you're mentioning names and brands there that are sort of household names, but I guess when you might have started working with some of those firms that were lesser known, like Laura. You mentioned Laura Ashley. That's very well known here in the UK. I think some of these brands, obviously they're huge companies, and you've got obviously a lot of experience from working in all different sizes and all different sort of a manner of situations you'd have managed. What would you say, looking back over that sort of 40, 50 years, have you got sort of 1 or 2 defining moments that you're very proud of?
Oh, wow. I mean, I'll talk about 2. Okay. One was and is an iconic specialty retailer in San Francisco called Wilkes Bashford. And Wilkes Bashford was sort of the equivalent of a smaller, much smaller 4 or 5 unit equivalent of what would be Bergdorf Goodman in New York, or Selfridges, and men's and ladies designer apparel. And when I got there, the founder was still there. He's a brilliant merchant. He had brought many of the iconic Italian brands to the United States 40 years ago, and got into trouble through overexpansion. That was at the same time that we entered the big recession of 2008, which I'm sure you remember, where luxury, for the first time ever, took a huge hit. And so I got there, and really as a consultant, based on the vendors asking me to work with the company, and ended up becoming the interim CEO of the company. We hadn't paid, suffice it to say, we hadn't paid our vendors for a year. Nobody was shipping. Nobody was buying at the same time. And we were, I was able to utilize their inventory to keep the company going long enough to get the vendors to ship again. And then we were able to, after a lot of hard work, we're able to get the company sold to their largest competitor, called Mitchell's in Connecticut. And it's been phenomenally successful acquisition. So, and we saved a lot of jobs and saved really an iconic institution. And that when you look at it, when you look at retailers and you look at the change that's gone on, the first thing we look at is this worth saving or not, right? And in this case, it was just a phenomenal retailer, and it would have been a shame to see that go away. So I'm very proud of that. And then the discussion that I had about Route 21, which again had emerged from a bankruptcy. It was a much bigger company, and everyone thought we were going to liquidate, and we were able to, we were able to turn it around in a fairly short period of time and saved 12,000 jobs. So, and also, obviously the investors were very happy as well. So, so it was sort of a win-win, but very hard to get from here to there. So,
I can only imagine. I was very much deep into my first main business in 2008, and I remember it very well. It was very challenging, very, very, very challenging times. We managed to scrape through, and obviously I know a lot of tough times for a lot of people trying to keep moving through the months and the year or two. That was a very, very tough time. Obviously, that's just one instance sort of thing, but it must be very rewarding, Michael, when you get a business that, as you put it, like an institution that you're trying to. Obviously, you've got to, can we save it? How are we going to save it? What we're going to do? Where we're going to save? Where we're going to invest? Or maybe not invest, but maybe what would you say? We're in a quite a challenging time again right now. Or you could argue different things, but when you're brought into a company that is having challenges, what is sort of do you have like a framework that you follow to try and?
Yes, I have sort of. Yeah. I have. Over the years, I've developed a playbook in that regard, and I've written and spoken extensively about that. And I think, well, assuming that once you get in there, you assume that you've decided that this company can be saved and has a reason for being, because there's quite a few companies out there that their time has passed. The competitive environment has changed. But assuming that you believe that the company has a reason for being, I mean, the first thing you have to think about, all right, in these situations is making sure you have enough liquidity. Okay. Yeah. And, as a merchant, as I started in the business, that was somebody else's responsibility. But as you become, CEO of a company or a financial advisor, you realize that, you can never make it work unless you have enough liquidity to buy you the time to fix the business. So that's the first thing that you address. And of course, we look at in our business at Getzler Henrich, the first thing we do is do a 13-week cash flow, which tells us, okay, what do we have enough cash, for the next 3 or 4 months, which then and if we don't, or if we have an issue with that, then we have to decide, do we need an injection of capital in the business, or are the things that we can do with the assets that we have to create liquidity? Yeah. So that's the first exercise you go through. And then, at the same time, and the thing about this is that when you're involved in a turnaround, you have to do things in parallel. You can't do things in a linear fashion, okay? Because you don't have the time to do it. So you've got to fix the balance sheet at the same time that you're fixing the business. So what I found in a lot of retailers and brands is the first thing you have to figure out is to really understand your customer, okay? And believe it or not, many of the companies that I've been involved with, who might be household names or large companies, have done very little consumer research. Retail is quite different than consumer packaged goods, where in that environment, in CPG, they live and die by customer research, right? Retail has been a little bit different and a little bit slower to understand how important that is. So the first thing I've done in many of these situations is if they have research, try to understand that, and if not, to make sure that we do a deep piece of segmentation research that identifies who are the different customer segments that are shopping with you, and are they, and usually, you have, it's not one customer. This whole idea of a monolithic customer is not correct, okay? And so if you've got research and shows what your segments are, you can look at those segments and you can say, okay, are those which segments are aligned with the brand and what the strategy is, and which segments are not really, they're not going to make a difference. At Rue, what we found out is that we had the business was essentially, a fashion business, a fast fashion business for teens, all right, who were interested in fashion. And there were segments, we had segments where they regarded clothing as utilitarian, okay? The fashion is just something to put on your body. Or the only thing they cared about was buying something at the cheapest price. Well, those two segments, are not going to take you to the promised land. You're not going to be profitable with them. So you have to price. Exactly. You have to focus on the segments that really will drive your business performance and will create loyalty and engagement with the brand. So that's the first thing, is like really understanding your customer and understanding, what's important to them. What are the most important things, for them? Is it fit? Is it price? Is it fashion? Or a combination of the three? How important is value in that regard, et cetera? So if you ask the right questions, you get a lot of really good answers that are going to inform your strategy. Okay, so that informs your strategy. The research informs your strategy, and then what you might have a great strategy, but it's all about execution, which means that you've got to assess the team that you have and decide whether you have the right people who can, as a team, execute against that strategy. And once you have that, then what you're going to do is you're going to really make sure that the product is the product that customer wants. And I think today, and I talk about this a lot actually, is, everybody's talking about AI, everybody's talking about technology, but they're not talking about product. Well, the retail, what do we do as retailers? We're in the business of buying and selling product, and hopefully at a profit, all right? And so I think that, once you've got the research and you've got the team together, they can focus on making sure that you've got the correct assortments that are in the right places, okay, in the right quantities to drive your business. And that's the same whether you're, and most retailers today have to be omnichannel, okay? They can't, consumers expect, to have bricks and mortar and expect you to be online. And they also expect you to be online in social media. And now in social media, a lot of people are selling on social media today. So you've got these three channels in a way where you're doing business. And so once you've attacked the product piece of it, then then the issue becomes technology, because what's happened today in retail is that, it used to be that most retailers were bricks and mortars retailers, and they might have had a catalog operation or something like that, but primarily the business was done in bricks and mortar, so that's where the focus was. But today, because you've got to play in all those arenas, all right, the cost of doing business has gone up, and it's gone up faster than, overall macro retail revenues. So the only way to make out in this situation is to make sure that you're much more efficient, so that you can make money. And today there are, embracing technology in the operation of your business as a retailer is absolutely critical. And if you look at the retailers who have been successful, they have been very progressive in that regard. And today, the other part of it is that, in terms of technology, is that, it used to be extremely expensive to implement technology platforms and businesses. But today, because of the cloud and because of the improvement in technology by a lot of these vendors, is that it's actually not that expensive and easy to install, and you get really great results. And that covers so many parts of the retail ecosystem. So, and I could talk about that for a long time, and what we did, and we did that at Route 21 very successfully.
Yeah, no, I think obviously some of the things you stepped through there, a couple of things sort of stood out for me, or one particular thing. So obviously when a business is having challenges and they need to, maybe bring a company in like yourself, or, it's clear they need to make some changes. You step through there, that initial piece of trying to make sure you've got, that first 13 weeks fairly nailed down. And if it looks like there's going to be some challenge there, which is quite often, I'm sure there is, as we'll be talking about it, sort of thing. Creating liquidity when it's quite, it's difficult to do. Have you got any sort of creative ways, or going back to your last 40 years, some creative ways how you created and improve the cash flow?
Exactly. Well, I mean, basically, you have to look at the assets that you own, right? Yep. And the major asset that most retailers own is inventory, right? So therefore, you have to look at the inventory that you own, and you have to decide how to get much more productivity out of it. Is it the right inventory? Is it in the right quantities, in the right places? Do you have too much inventory that's aged? All right, and if that's the case, and you find that with most of them, right? Especially, it's like, they're in love with the merchandise. Except the problem is, if it doesn't turn fast enough, okay, that can sink you. So you have to be very, analytic about looking at that and say, okay, what can we do with this? And it's a combination of, and one of the things that we did, in addition to just looking at the content of the inventory, was looking at how do you buy, all right? And are you buying stuff that's really going to sell and that's going to turn rapidly enough to create that cash flow that you need to, to operate the business? And we used predictive analytics in that regard, in terms of, if you're not buying the right stuff to begin with, what you're going to end up with is markdowns and clearance, and that's a problem. So we worked with a company that had been in the business for a while, that used predictive analytics to help the merchants choose the right products to buy, and also to determine which products they're considering were not going to sell. And they did it quite, it was really utilization of AI, predictive analytics, to do that. And they assembled panels of your consumer, okay, who had a history of picking the winners, right? And when you assembled those consumer panels of people who picked the winners, and you showed them product you were thinking of buying, there was a direct correlation between high scores and whether the product would sell, and low scores that where you were buying markdowns. Okay, so if you utilize that technology, you're going to buy more of the winners, drive more business more profitably, and you're not going to buy the losers. So it's just as important to not buy stuff that's not going to sell in that regard. And especially when you see that in apparel, okay? Because if they don't like it, all right, it's hard to find a price they're going to buy it at, in that regard. So we were quite successful in doing that.
Yeah, it's a big thing, isn't it? That sort of, and you've got the returns element. Certain items are going to return higher than others.
Right.
I used to run a technology business prior to the agency, and that was always a big problem for us. Technology, for example, if somebody plugs it in and it doesn't work, they send it back, and it might sit on a shelf. But if it's a £500 thing or a $500 thing, that's a high value, high ticket item in e-commerce. Next thing you know, you've got 4 or 5% of your inventory sitting in returns or sitting in, seconds, whatever you want to call it. Obviously, that's a huge percentage sitting at the balance sheet. Yeah.
And the issue is this: is that what I found over the years is that you're going to know pretty soon, all right, whether the product is going to perform. And so the critical thing to do is to take appropriate action and not wait and sweep it under the rug, because you're much better off. They always say your first markdown is your best, but if you wait too long to take it, right, you're going to be in trouble. And it's really interesting. I'll never forget this. One of the first businesses that I was involved with as the president was a cutlery business. It was a gift business that specialized in cutlery and personal care items. So it was all hardline items, right? And so the owners of the company, felt that it's made out of metal or this or that, and it's got some value no matter what. Well, guess what? If it's not selling, all right, it doesn't make any difference. So what we had to do very, very aggressively was to say, okay, these are not selling, they're not turning, and they're tying up cash, and therefore we can't buy the key items that are driving the business. So, what we did, actually, I'll never forget it, with the merchant that worked with me, we just basically, because it was a privately held business, and the bank was only willing to go so far. We just said we're gonna not buy the bottom 25% of the assortment, right?
Yeah,
and we're gonna take that money and we're gonna pour it into the key items. And within a year, we went from like minus 10% comp store sales to plus 10% comp store sales, just by focusing on the basics and having the discipline to do the right thing. And it's fascinating. And these types of basic things still it hasn't really changed. Okay, in that regard.
Now, you might be looking for an SEO boost, a down-to-earth digital PR campaign to share your story, or maybe just some straightforward technical help to amp up your performance. Now, that's where eCom Now comes in. A partner that's all about making things easier for your online store. Our services cover everything from creating professional content for your e-commerce categories to refining your product descriptions. Now, whether you're just starting out or have been in it for a while, we're here to deliver real, impactful results that add to your bottom line without unnecessary commitments. You can order one-off or multiple projects with a quick turnaround. Simply choose what you need.
So, obviously, you've worked with a lot of different firms, and obviously still are. What are some of the common themes you see why companies fail, on the sort of retail side of things?
Okay. Well, I think sometimes what happens is that a retail concept is no longer valid, okay? So that can be the case. I remember many years ago, there was a type of retailer that was called a catalog showroom, okay? And I don't know if you remember what those were, but basically, you'd go into the store and there were these sample one of each, and then you'd go to the counter and they get it for you from the back. Well, that was right. Well,
that was called in this country. Argos was the big brand for that.
Really?
Anyway, it's still a thing, but it's a lot smaller thing.
Right. So what happened in the U.S. was that all of a sudden, big box retailers came, right, and they had bigger assortments, sharper prices, and they basically put the catalog showrooms out of business. So, there's that situation, all right? Then there are situations where well, I think most of the reason why, I would say, if there's a reason for being, all right, then it's usually management, okay?
Yeah.
It's usually, they don't have the right management that can fix the business. And very often what happens is that what you see is when you go in is you have a management group that, they've been there for a while and they were there when the business was growing. But then when they started to hit challenges, they couldn't pivot. They didn't know how to operate in a turnaround environment. And so all they thought was, well, all we have to do is do what we're doing and do it better, and we'll be okay. As opposed to, no, you need to start doing things differently if you're going to turn this thing around. And that's difficult because they just don't know how to move quickly enough and reorient the strategy.
Yeah,
and also you got to get the right people in, and that's always difficult at times because you go in there and because I've seen so many businesses. All right, it doesn't take me long to assess the quality of management, and one of the other problems too is that you will have a situation where the board will decide to replace a CEO. And a new CEO will come in, and they will decide that they have to clean house, and they get rid of everybody in the C-suite. And that's a huge mistake because in most companies, not everybody's bad, right? And so you have different skill levels, and also those people understand the DNA of the company. And if you get rid of everybody, you lose the DNA.
Yeah.
And that can kill you. And we've seen this so many times. The other piece of it too, and we can talk about this with two companies in the United States. One was JCPenney, and the other most recently is Bed Bath & Beyond, was they brought a new CEO in, and they decided to basically fire their customer and completely change the business model, without testing it. And, and in both cases, it killed the business. I mean, JCPenney's only alive today because of the fact that the mall operators, decided that it was cheaper for them to own those businesses and keep them, all right, than it would have been to get rid of them, to close the company, and then you get your you lose your rent rolls for your specialty retailers because when
a big hole in your store with no tenants
and most of the leases in these malls say that if you lose your anchor, all right, they can go on percentage rent as opposed to paying the rents that they're paying. So that's a killer. So that's why JCPenney is alive. With Bed Bath & Beyond, that was really a tragedy because, again, activist investors, the company wasn't doing as well as it should have. All right, but it wasn't going out of business, and they launched a successful proxy fight. They got rid of the entire board and put in a new CEO who had come from Target. And I don't know, do you have Target in the UK?
No.
Okay, well, it's like Walmart. It's Target or Walmart.
Yeah, I'm aware. Yeah.
Okay, so he came from Target, and he had never been a CEO before, but he had been very successful building up their private label programs, their private brands programs. So he came to Bed Bath & Beyond, which was really known for, you go to Bed Bath & Beyond for the brands, right? So you're a big box retailer, you go all the categories of home, and you're carrying all the brands that people want. And so he decided to get rid of the brands and just put in and produce all these private label programs, which did not resonate with consumers, and didn't test the concept. And it amazed me when I saw it because they said I went in one day to look for a what a dustbuster is, a little cordless mini vac. Okay.
Yeah.
And it's like the most basic thing you can think of, right, around your house. So I went into their new concept store, and I said, I'd like to get a dustbuster. And they said, well, we don't have a dustbuster. I said, well, I don't really care. It doesn't have to be that brand. It could be just another version. They didn't have anything. And I said to my wife, these people are going out of business. Okay. And unfortunately they did. And there was no reason for it. They just needed to, they needed to fix, they needed to improve their merchandising, but they didn't need to change the business concept and the business model. And the board allowed them to do it. So, that was and that has happened more often than you think in apparel as well. You have apparel retailers where they get rid of it. And, apparel's a tough business, right? Apparel's a tough business because you're in, especially in the fashion end of it, is that, not every season's going to be fabulous, right?
Yeah.
Which means that you've got to have enough liquidity, a capital, to survive, the inevitable hiccups. But, what happens, especially if you're a public company today in the United States, is that if you don't make your numbers, the boards are not very understanding. And so, they get rid of the CEO, they bring a new CEO in, and, they change the assortments,
DNA,
et cetera.
I thought that was a nice, they lose that DNA. It's a brand that's been known for X, Y, Z for, let's say, 20 years. Of course, things need to change, but to come in there and just completely wipe out the whole, say, C-suite or a certain level of management, well, amongst those people are going to be some fundamental key people that have made some very, very, very good decisions along the way. Of course, there's the challenges that you're now facing as a company, but to come along and then wipe out everybody or wipe out the core, it's just, I see that.
It doesn't work. It never works. And smart CEOs understand that that they have to have the right balance in that regard. Because
if you're coming in as a new, so let's say the CEO has to change or has changed, what would be a if you were recommending and engaging a new CEO for a firm that you're helping restructure, what would his sort of first 90 days maybe look like? Would he then
or hers?
Yeah, sorry, yeah, of course, yes, of course, his or hers, of course. What would that look like? What sort of key things would they be focused on?
Well, I think successful successions have said, in the first 90 days, it's like you really should dig in, understand the customer, and listen. Yep. All right, listen and learn. And of course, if you're running out of money, then at the same time that you're doing that, right? You're listening and you're learning and you're getting a point of view about the business, and I think that will inform what your game plan is. Yeah. So and I think, and also look, if you're and whether you're bricks and mortar or e-commerce or omnichannel, it's talking to your customers. I mean, I think that any retailer that's got bricks and mortar, I mean, if you want to know, I always used to say, if you want to know what's going on at a business, in a retail business, you're not going to find out at headquarters. You've got to find it in the stores, okay? Because
secret shopper.
Well, you don't even have to be a secret shopper, okay? You just have to be out there, and when you go to the stores, the staff will tell you what's right and what's wrong, and your customers will tell you what's right and what's wrong. Yeah. And most consumers, if they're in the store, they have some level of engagement with the brand, and they will tell you what they think, what you're doing wrong, what they love, etc. And it's amazing how much you can learn. I would be in the stores like as often as I could. If I could go one day a week, I would, because you can learn a tremendous amount about about the business, about the customer, etc. And there's if it's an e-commerce business, then you can get you can do focus groups. You can get on the phone with them. You can do all sorts of research. As long as you ask the right questions, you can get those answers. And also, really looking at, we did a lot at Rue with understanding through customer service engagement, what was important, what they liked, what they didn't like, that was really helpful. And we had a very, very smart guy who was our SVP of data analytics, and he was able to aggregate all the customer service comments from all the different areas of the business, so that we could tell overall what was the most important things to our consumer, and what were we doing well and what we weren't doing well, et cetera. And it's very useful to have that information, okay, instead of assuming that we're great, okay. And in some cases we were, in other cases we weren't, and like, for example, with I've been involved with a lot of businesses that have plus size assortments, and in those businesses, fit is number one, okay? Because if the garment doesn't fit, it doesn't make any difference if it looks great. If it doesn't fit properly, and there are technical issues, and the companies that do it right, what's really interesting is the company that I'm involved with now, Ashley Stewart, has an extremely low return rate, because the product is the fit has been consistent, and the customers know, they know if they're a size 14, they're a size 14, regardless of what they buy. Exactly. And returns have been a huge issue in the retail business today, and it's tanking a lot and between that, especially in apparel, between that,
I think a lot of apparel companies have sort of reversed their, you get free shipping and then free returns. So then what a lot of company or customers were doing were buying 2 or 3 sizes, and then obviously trying whatever on, sending 2 back. But obviously you've got a cost of return, and then you've also got a couple of products that are obviously seconds or used potentially, and it creates obviously a whole cash flow, everything.
If it's a seasonal apparel item, right? The season is short, so you don't want to end with a lot of older, aged merchandise in that regard.
Yeah, getting about those 60 days.
Yeah, they impact profitability dramatically. So it's kind of like, it's the devil's in the details. All right, and I think a lot of companies have gotten into the mistake that they have to offer free shipping or free shipping at a very low threshold, because they're all competing with Amazon. Except Amazon, you're not getting free shipping from Amazon. You've spent $150 a year, right, to be a member. So, but once you paid it, people forget it and they think it's free. But the reality is that you have to figure out what you can afford. What should the shipping threshold be, and what should the return policy be? I mean, one of the things that we see too is, we don't want customers returning garments that don't have the original tags on them, because we know what that means, right? They've worn them, and exactly. So, and that's really that's a problem. So, and I think that a lot of retailers are grappling with those issues now. Finally, all right. Saying.
Yeah, I think it's sort of gone full circle, because like maybe even like 3 years ago, free delivery, free returns, all free. But now, hang on a minute, that's biting everybody. Now in terms of that extra 5-10% that we all need, and all our customers need. So I think we're going to have a lot of retailer clients, a lot of retailer listeners in our omnichannel e-commerce. So for those that have the retail stores, I know we've got quite a lot of large retailers with 300-400 stores that are clients, they're listeners. What would you say to those guys? What do they need to focus on in the next 12 months? They've got a heavy investment in retail and the e-commerce as well, but they've got a heavy investment in the retail side. What would you say to those guys about having a successful sort of 2024, start of 2025?
Yeah. I mean, I think the UK is a little bit different than the US. But in the US, the economy is not bad. However, consumers have become much more discriminating in terms of who they shop with. So, it all starts making sure you have the right product, right? And making sure you understand, how important the value quotient is to that customer. And making sure that you have the right balance of full price and promotional in that regard. But again, making sure that you get much more, really into the inventory content and an inventory investment, because I think that that it's still going to be challenging. What's so interesting is you see this bifurcation in performance between the haves and have-nots in the United States, and that you have some retailers that are doing fabulous. All right, I mean, of course, Costco continues to do fantastic. Walmart is doing well now too, because I think customers are very value focused. Yeah. And they're also having to spend more of their money on grocery, and Walmart's the biggest grocer in the United States. Yeah. But then you've got, people like Abercrombie and Fitch, who have very successfully turned around that business. That's been a great transformation. And they really have nailed who their customer is, what they want. And they're doing really, really well. So you see those, and of course Lululemon continues to do it. And they all continue. The good ones continue to focus on their customer relentlessly, really work on the in-store experience. You go into a Lululemon store, and you have salespeople that are knowledgeable about the product, really helpful, right? Yeah. And you don't have the turnover that you have in some of the other retailers. And frontline turnover can really kill you. And if you have engaged associates that are engaged with the brand and engaged with the customer, you're going to do a lot of business. So it's kind of the basics, but you really have to focus on that relentlessly. And
so if I was, I am a bit of a hobby investor. So if I was, obviously I'm got my ear to the ground more on sort of the tech side of things in tech companies. But if you were, this is not professional advice. We're not financial advisors, but if you were to invest tomorrow in a couple of high street retail chains or brands, is there a couple of brands that spring to mind that you think are doing well?
I'll tell you, I like Lululemon because I think they continue to innovate. I like Lululemon. I like Aritzia, which is a great specialty retailer out of Canada. I like Ulta Beauty. I like Sephora, which of course is part of LVMH. I mean, I think LVMH is really that they really understand their customer, and they're not afraid to invest. And I don't know if you've seen, they bought Tiffany's recently, and they invested $500 million in their New York City flagship, and it will pay off. They play. They have the capital structure to play for the long ball, and those types of people, and and they also own Laura Piana. Classic luxury companies are doing really well, and they own Sephora too, which is continuing to do really well.
So I will. I'll make a note. I'll make a note of those in the next day or two, and then maybe we'll get you back on in 12 months' time.
See how they did, right?
It's the AR prediction.
Right. The thing that's interesting is that, you can't, with some of these companies, from month to month, the stock will go up or go down, but long term, you're going to do really well, because they really understand their customer. They continue to invest in the business, which I think is critical for retailers and technology, and the results show.
Yeah. So I think that it's been really fascinating listening to you. I feel like we could have a 2 or 3 hour podcast. Fascinating, but I think I'd like to end on a couple of sort of more sort of personal touches to the founders that are listening. When times are tough, and the ups and downs of running a business, and particularly a retail business. What would you say to those guys that are running a retail business now that when times are tough? And you've really got to dig deep. Have you got sort of words of wisdom to those guys, when around sort of their mindset, mental health?
Yeah. Well, I mean, look, you have to not panic. Number one. Number two, you've got to really preserve liquidity. All right, because it's just critical. I can't stress it enough. Coming coming from my background as a merchant, right? You learn that you can't do it without the liquidity gives you the time and the tools to turn around the business. Okay. And also I think in times like this, which is really interesting, I always say you can't afford too many retailers play it too safe in the sense that they don't focus enough on new, exciting product. And they just, like try to play it safe on innovate stuff. Yeah. And you can't do that. You have to, consumers in this environment, especially when money is scarce, to get them to open their pocketbook, you've got to excite them, and make sure that there's newness, there's excitement, to get them to buy it. Because you know what? If you're in the apparel business, if you have a blazer in your closet and a pair of black, pants, well, you don't need more of that. Okay. Yeah. You need a great blouse. You need something, a great, great accessories or whatever. So I think that a lot of retailers, particularly in the fashion business, sort of when you play it too safe and you're not continuing to innovate and introduce new product and excite the customer, you're gonna suffer. And you just have to do it properly balanced. That's all in that regard.
Yeah. I think that's fantastic advice, Michael. Now, thank you so much for coming on the show. I think so many takeaways. We'll make sure everything's highlighted up in the show notes. For those that want to reach out to you, Michael, find out more about yourself, more about the practice, what's the best way to do that?
So I'll give you, it's Michael Appel, Appel, and I'm the retail practice leader at Getzler Henrich. I'm not going to spell that out, but my email address is mappel@getzlerhenrich.com. And my direct line is 917, in the U.S., 917-789-3615. And we're open to chatting with clients and retailers. We love to meet them and chat with them. And hopefully, if they need help, we have a great team that can do anything. And we also have, our team also has IT experts and supply chain experts, as well as financial restructuring experts as well. So we like to say that we have we have everything covered in that regard.
Yeah, fantastic. Well, we'll link all the contact details up in the show notes. So one final thing from me then, I like to finish every episode with a book recommendation. Do you have a book to recommend to our listeners, Michael?
Oh gosh. Well, I like which book I really liked. I really like Leonard Lauder's autobiography. The former CEO of Estee Lauder. I thought it was a fabulous book about and he really built that business, and his insights I thought were fantastic. And also it's also kind of interesting because he was navigating. He took over from his mom, who was a force of nature, and how he was able to navigate through that, and also to build the business model, and how that model changed over time. And one of the things that I thought was fascinating was he thought at one time that there was so much going on in the beauty business, and that the best way to continue to innovate was to buy a lot of these young, up-and-coming brands like Bobbi Brown, et cetera, and as a way, and keep the management there, right, in order to continue to grow the business and grow the portfolio. And I thought, he had a lot of different insights like that. Which
that sounds fascinating, actually. I've got a little trip coming up in a couple of days, so I think I'll get that delivered before then, and that'll keep me busy for a couple of 3 days while I'm
and I think it's by Leonard Lauder, and I think it's called The Company I Keep. All right, it's an excellent book.
Fantastic. Well, Michael, thank you so much for coming on the show. We'll maybe touch base in 12 months. 12
years. Okay.
Maybe we won't leave it quite that long. We'll maybe go 12 months. If I'm still podcasting in 12 years, that'll be episode 700 and something. So,
right.
I'm not sure I've got that many left in me, but it's been fascinating, Michael. Thank you so much for coming on the show.
Rich, it's my pleasure. Okay, have a good day.
If you enjoyed this episode, hit the subscribe or follow button wherever you are listening to this podcast, so you're always the first to know when a new episode is released. Have a fantastic day, and I'll see you on the next one.